What makes a company trustworthy? What gives it the ability to attract top-tier clients and investors? In the world of investment banking, the answer is simple: history, tradition, and reputation. Think about it. Would you trust someone to manage millions or even billions of dollars if they didn't have a proven track record? Probably not. That's why investment banks with histories spanning over 200 years are so powerful. Their names alone inspire confidence and open doors. But how did these firms get here? What makes them so essential in today's economy? In this video, we would be looking at the fascinating history of investment banking, a journey that will show you why history isn't just an interesting fact in this industry. It's a critical asset. By the end of this lesson, you'll not only understand how investment banking was born and evolved, but you'll also pick up some nuggets of. So grab a notebook, because this is more than just a history lesson. It's your gateway to understanding one of the most prestigious industries in the world. In most industries today, the focus is on innovation, with companies constantly looking forward. But in investment banking, history is everything. The power of institutions like Goldman Sachs, JP Morgan, and Morgan Stanley goes beyond their services. They represent a legacy of trust, expertise, and connections that have been built over centuries. Consider this. You're a tech startup aiming to go public. You have two choices for your investment bank. One is a relatively new firm, established just 5 years ago. They've completed a handful of deals, but their reputation is still growing. The other is a firm with more than 150 years of experience, a global network of investors, and a solid history of handling some of the most high-profile IPOs in history. Who would you choose? The answer's clear, right? The average age of the world's top investment banks is over 170 years old, with the youngest among them still having a history that stretches back 80 years. That's not just a number, it's the bedrock of their success. This deep-rooted legacy gives them the credibility to attract elite clients and navigate even the most complex financial waters with ease. When you're looking to make big moves in the financial world, having a firm with a proven track record and decades, if not centuries, of expertise behind you can make all the difference. The older the firm, the more you benefit from their finely tuned understanding of markets, their established networks, and their ability to handle the most intricate financial transactions. The beginnings of investment banking. Let's rewind to 19th century America, a time when the economy was booming. Railroads were stretching across the country, mining companies were extracting valuable resources, and heavy industries were taking off. But there was a problem. The commercial banks at the time just couldn't keep up with the massive demand for financing these huge projects. Back in the day, their main job of investing banking was something called security underwriting. But what does that mean in simple terms? It's actually pretty straightforward. Investment banks would buy stocks and bonds from companies that needed cash to fund their big ideas, like building railroads or launching factories. Then, they'd turn around and sell those stocks and bonds to investors who were looking to grow their wealth. But investment banks didn't just work with businesses, they also worked with governments. When governments needed to raise money, say for a new project or war, they would issue bonds. But selling those bonds wasn't as easy as it sounds. Governments didn't have the know-how to price the bonds fairly or to find the right buyers. Investors, on the other hand, weren't too keen on trusting governments to negotiate in their best interest. This is where investment bankers really earned their stripes. They stepped in as trusted middlemen. They made sure the bonds were priced right, ensuring governments got the funding they needed and that investors were getting a fair deal. Through this work, investment banks built a reputation for being reliable and trustworthy. They protected both sides. Governments got their funds, and investors were confident they were making secure investments. This system of underwriting bonds became the foundation of investment banking, and it's still one of the key roles they play today. The power of reputation. Here's a story that shows just how powerful reputation can be in investment banking. In the early 1840s, 8 American states faced a huge crisis. They defaulted on their loans after the cotton market collapsed. Investors were terrified, fearing they'd lose everything. But the investment bankers, they didn't just sit back and watch. They took a bold stand, refusing to help these states raise any more money until they agreed to a fair restructuring plan. Instead of jumping in to save the day, they held firm, protecting investors and demanding a solution that would work for everyone. This move wasn't just about managing money, it was about managing trust. The bankers' decision to stand by their principles earned them a reputation as the reliable, trustworthy middleman who wouldn't let investors get burned. Fast forward to today, and that reputation still holds incredible power. When you see a deal led by a major investment bank, it's often the bank's name that gives investors the confidence to jump in. The reputation of the bank serves as a stamp of reliability, reassuring everyone that the deal is solid and the process is fair. For example, if a huge company like Apple or Tesla is looking to raise funds, they'll often partner with a top-tier investment bank like Goldman Sachs or JP Morgan. Why? Because their reputation alone brings credibility to the table. For early pioneers and their impact. When we talk about the legends of investment banking, one name always stands out: the Rothschilds. But they weren't just bankers, they were true pioneers who created an unmatched global network that revolutionized the industry. Here's a jaw-dropping fact. During the Battle of Waterloo, Nathan Rothschild got wind of Napoleon's defeat before anyone else, thanks to his incredibly efficient courier system. With this inside scoop, he made some strategic investments that earned him a fortune. Talk about insider knowledge and quick thinking. This kind of foresight and sharp strategy is exactly what made the Rothschilds legends in the world of finance. But the Rothschilds weren't the only ones making waves. Families like the Morgans, the Lehmans, and the Barings were also shaping the future of investment banking. These dynasties didn't just make money, they built the very foundations of the institutions that still dominate Wall Street today. These early pioneers set the stage for the powerful banking institutions we see now, and their impact continues to be felt around the world. Commercial investment banks. You might be asking, why can't regular banks handle all these big investment deals? Well, the answer comes down to what they focus on. Commercial banks are the banks you're probably most familiar with. They focus on the day-to-day needs of regular people, like taking deposits, giving out loans, and helping small businesses. Their main goal is to serve customers and keep the economy running smoothly at a smaller scale. Investment banks, on the other hand, are in a whole different league. They handle much larger, more complex financial operations, things like helping companies go public, managing billion-dollar mergers, and advising on massive financial deals. These are the heavyweights of the financial world. To put it simply, a commercial bank helps you buy your first home. An investment bank helps a multinational corporation buy out a competitor. The scale, the stakes, and the level of complexity are miles apart. While your local bank is great for personal loans and savings, an investment bank is the one you'd call when you're making moves in the world of massive business deals and international finance. Back in 1933, the US government passed the Glass-Steagall Act, which required that commercial and investment banking be kept separate. The goal: to prevent conflicts of interest and protect consumers. But fast forward to 1999, and the act was repealed, allowing banks to merge both services under one roof. Today, we have universal banks like JP Morgan Chase and HSBC, which offer both commercial and investment banking services. This integration means that clients can get everything they need from one place, whether it's a home loan, a credit card, or advice on a multi-billion-dollar deal. But this combination of services isn't without its risks. When banks handle both personal and high-stakes investment transactions, there's always the potential for conflicts of interest. For example, what if a bank's commercial side is advising a company on a loan, while their investment side is handling a major deal with a competitor? To address these concerns, banks have implemented strict regulations and ethical barriers, known as Chinese walls, to make sure one side of the business doesn't unfairly influence the other. So there you have it, the origins of investment banking and how it evolved into the powerhouse industry we see today. Until next time, remember, knowledge is the first investment you make on the road to success. Don't forget to like this video and subscribe.